Ladies and gentlemen, good evening and welcome to the roundtable and webinar on real estate and structured finance, fundraising and fund investments, innovative and emerging structures. This event is being organized by Nishith Desai Associates in association with the Indian Private Equity and Venture Capital Association and Asia Pacific Real Estate Association. The speakers are MASATOSHI MATSUO, President and Chief Executive Officer for Genkai Capital Management Company Limited; KARAN BOLARIA, Head of Godrej Fund Management Private Limited; NISHCHAL JOSHIPURA, Partner for Private Equity and M&A from Nishith Desai Associates; RUCHIR SINHA, Co-Head Private Equity and M&A from Nishith Desai Associates; and Mr. VYAPAK Desai, Partner for Securities and International Commercial Dispute Resolution Practices from Nishith Desai Associates. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions at the end of today's discussion. If you should need assistance during the call, signal for an operator by pressing star and 0 on your touchtone telephone. Also, you can download our mobile applet, Nishith Mobile, which is available on the App Store for iOS device, Play Store for Android, and BlackBerry World to access the current updates and videos. Please note that this conference is being recorded. I would now like to hand over the session to VYAPAK Desai. Thank you, and over to you, sir.
Yeah, thanks a lot, and thanks a lot for everyone here to join this webinar and the roundtable. And I guess it so happened that it became, of course, this was planned a little early, but some of the announcements made by the government recently, not only that they were some of the announcements, I must say they are path-breaking announcements, particularly overall for the FDI sector, more particularly real estate. So I think that made this conference or this webinar even more appropriate in these times. So without taking too much time on the general introduction, which I guess everyone knows in terms of the speakers here, maybe we can start the discussions here. And to start with, let me first go to Matsuo-san. Yeah, I think he's the president and the CEO of Genkai Capital Management, a Japanese fund. And I just wanted to, know your thoughts as to, let's say, why you are in India. What are your thought processes compared to other jurisdictions when it comes to particularly the real estate sector? Because we have not seen many Japanese investors in the past looking at India, particularly for real estate sector. We have seen it for various other industries. So maybe you can give a little more broader picture in terms of how you look at India real estate sector, and what are your thought process in terms of strategies in investments, and what you expect from India and government going forward.
Okay. Hi, my name is MASATOSHI Matsuo from Genkai Capital. My company is a real estate fund management company with the Japanese institutions behind us. 10 years old. Now we run around 2 billion plus US dollar asset under management. So far, our company is managing the Japanese institutional money and investing only into direct real estate only in Japan. Japanese, as you might know, market is very saturated, and the cost of capital is so low. Many of you may know, but the government bond 10 years only yielding 0.3%. It's very, very different from your country. It's almost laughing. Yes, it's a laugh. I don't know why our country has so much capital and nowhere to go. It's a kind of sad situation. But because of this kind of a cultural and also communication barrier, we are not so good at investing outside of a country so far. So for us, it's a challenge, but our thought process is like we are doing a lot of our investment in real estate in Japan and yielding good office building 3%, 4%, and trying to gearing up to 80% and trying to make it like 5%, 6%, and betting on this upside capital gain or loss. It's a very, very risky game, but we're so used to it. We're taking so much of risk in that direction, but we're not kind of ignoring the opportunity outside the country. Our country is maybe same today India 40 years ago. 1970, people were buying real estate, buying a house without no down. Even the cost of capital is 7% at the time, but everybody's jumping on to buying the house. My grandmother telling me, once you get the job, just buy a house, borrow money, buy a house. That's the normal way of thinking. But the market has changed after the bubble burst, and people are not thinking that way. But still, we're hanging on to this same old myth of a land. So I want to change that kind of way of thinking for at least for institutional investors to look outside. And this country is just in a good timing for the economic growth. And more interesting part is this country has a very interesting, financial policy, which try not to, see the bubbling situation of real estate. So capital is very restricted. So I see this is very interesting, opportunity for us to bringing more patient, cheap cost of capital money. Yes, there are so many risks which these guys gonna tell us later, but handling these risks, and I think this is our mission to bring this patient long-term capital to place this country. We're not just a hedge fund, so we don't need to bring the money back in 3 years with 20% IRR. We are to play a longer term investment. It's a challenge, but for thinking about this kind of a situation, I think this is our opportunity and also our mission to do this kind of long-term investment in this country. That's why we're here. But as you know, I mean, we're beginners, and so we're learning a lot of things. It's a lot of headaches, but I'm very optimistic about this opportunity. I'd like to take a risks, and I'd like to show our project to the investor and see how we can grow from there. I think opportunity is so big and we can do so many things. That's my thought process.
So obviously we have not heard a lot of praises for the restrictions that Indian government puts in. Possibly this is one dimension to it, and that was possibly one reason that India also faced the economic crisis little better than the other jurisdictions. But of course this is particularly a new dimension that we'll see as to how the Japanese funds and the market looks at India. Going to Karan, and as you would know, he's the head of Godrej Fund Management. It's one of the first successful real estate platform with APG, and I think in the last 3 years you have done a very, very successful fundraise, particularly on the residential real estate market. So what is your thought process and what are your views when it comes to driving of these investments through these platforms? How would you see these platforms working compared to funds generally coming directly without a local joint venture or other structures that are available? So what are your views and what is your experience when it comes to such platforms, and how have you done it successfully in last 3 years?
Yeah, so I guess from our perspective, we started in the reverse manner than what other fund managers did. We went bottom up instead of going top down. So our first structure was a platform structure that we worked with Nishith to come up with. At the time, that was quite innovative, and then people wanted to get involved in a platform type structure. But the journey for us is actually quite different. We are now innovating again with structures where we are going more towards a pure play real estate fund structure, where we manage the investors and we discharge the fiduciary duties to them, and therefore we become a full manager. So the reason actually we can do this is because we had an unhindered look into the entire operating business that we run, which is pan-India, and that really taught us where the mistakes happen, where the problems occur, whether it's approvals process, whether it's the costing that goes into the developments of residential units, or whether it is the timing, the time lag, all of those things we thought we got a superior view on, because rather than there be a developer and a manager, and the manager's kind of second guessing the developer, we had a full access to it. So what that did for us really is that it allowed us to change the way we underwrite projects. I think that is different from any other manager that exists today in the country. And when we underwrite, we are able to, we think, price risk correctly. So therefore drive up risk-adjusted returns. Our investors thought that the first round was a winning strategy. We also went and spent a lot of time taking the Godrej philosophy of very high corporate governance and highest levels of transparency, and we morphed it into a fund management business. So now what happens is that investors who want to work with us, they're much more confident. More people want to come out and join our sort of fund management program. So we are able to innovate again and actually go more towards the fund structure and actually get away from the club type structure that we actually started with. And of course we work with Nishith Desai here to continue to build those structures.
Sure. So maybe I'll come back to you with maybe a little more specific or a particular example or an experience that you may be able to share. But before that, maybe Ruchir, if I come to you. In last 10 years, I think we have seen several different structures when it comes to real estate investments. Right from simple equity to debt to NCDs, some of the in the listed space and otherwise. So how do you see whether these structures have now matured? It's more, I would say, taken a shape where most of the things are happening in a particular manner, or there are still innovations which are seen in the market, because real estate is a very different asset when it comes to investments and the exits. Also with the recent changes, which I guess everyone is now looking at, particularly generally under the FDI route, where a lot of different structures are not possible, and particularly real estate, where a lot of liberalization has happened in terms of the specific requirements and exit requirements. How do you see the past structures going forward with the new law, and what are the new innovations that you see which will bring another spree of excitement in this sector?
Sure. No, I think obviously these are very extremely interesting times. Real estate opened up in 2005, and in about these 10 years, I think we have seen a complete cycle. Move from pure equity to preferred equity to structured debt to pure debt, and now in the past, I would say in the course of past year, a resurgence towards again pure equity. So I think it's been a whole cycle which has come up. I think the way I see the market shaping up, at least in the current times, is that debt obviously remains the flavor for SPV level. Reason is in most cases in residential, etc., it's self-liquidating assets. There's constant income upstreaming required, but obviously becomes more tax optimized when you push in debt. The other reason for debt popularity was always that real estate is not like innovative tech, which gives you 45, 50, 70% returns, right? Debt, at the end of it, if at all it did really well, kind of gave you about 20% optimized return. So, that's what real estate gave, and those were debt-like returns. And at the end of it, it was asset-backed or hard asset-backed. So, stabilized assets or real assets have their own means and mechanisms of investment, and people preferred. that there should be some kind of security creation also, which should be which should exist, which was not there, which was not possible in pure equity like structures of 2005 with equity and instruments compulsorily convertible into equity. So I think there were many reasons from tax perspectives, commercial perspective, security creation, many of that reasons which kind of drove the structures towards debt, and that kind of drove the entire cycle. And I think we'll be covering on structured bonds or listed NCD, which we pioneered. NISHCHAL and I personally did the first few deals in that, which became the market standard. And about 75% of the offshore capital that came in the course of last year was structured by way of listed bonds. So that really became the flavor. Now, slowly, because there has been so much of debt which kept coming in, and obviously there was a mushrooming of domestic debt, the NBFCs, and all large LPs setting up domestic NBFCs because there was a need for onshore debt, that ultimately there was a huge scrambling for players, a lot of capital chasing very few people. And over the course of time, what also happened is that the spreads kept becoming thinner, so, and somewhere down the line, all of a sudden we saw a burst. I mean, Karan, your platform was probably one of those few places where large funds like APG and others said, we repose faith in large developers, we want equity like returns, and they put that money in. And then we worked on on other deals, the Goldman Piramal example is one, and there are many others which kind of saw the trend changing towards taking equity risk with larger developers having substantial track record. So the situation changed from debt deals towards pure equity, and these deals, if you see the past trend, these are entity level deals. Like the Goldman Piramal deal is not an asset level deal. It's an entity level deal where you're reposing faith in the brand, and that kind of track record. So I think and that kind of trend is likely to continue with the larger developers. And obviously for the bigger players, there's obviously no challenge for capital. For the smaller guys, I think that will still remain the way it is. And just while we were on the anvil of unfolding equity and the resurgence of equity, I think the time couldn't have been more opportune for the government on this Diwali to open up the entire FDI or the foreign direct investment policy for real estate. And I think all of you might have seen it, but in your bags which you have, there is this hotline. It's called the Real Estate Update, where we've analyzed all these amendments and all the changes. So I will cover some of them, and some of them will be covered by NISHCHAL. But I think there are three or four major changes which they've made. The first is on the minimum area. So earlier we used to have a 50,000 square meter built up area restriction in Press Note 2 2005. That got reduced to Press Note, that got reduced to 20,000 square meters. And now that area has been totally done away with. So now you can actually have situations, some people feel it is too good and probably a little aggressive, but I think good is better because now every project every small project, irrespective of the size, can avail of foreign direct investments. So there's no area restriction. So in your small bungalow or in your small parcel in the heart of the city, you can have foreign direct investment. And I think that was pretty important because even when, we were reducing it to 2005 and at a policy level, we had recommended that this 50,000 never made sense because in heart of the city projects like, Bombay or Delhi, you didn't have 50,000. And where you had 50,000, like in tier 2 cities or maybe in certain far off areas, if investors didn't want to invest. So I think the area restriction is one of the major changes, which is likely to accentuate foreign investment. The other is on the minimum capitalization. There was a $5 million which was brought in. It was earlier 10 million and now it was reduced to $5 million in this Press Note 10 of 2014. That $5 million has also been reduced to nil. But the benefit of $5 million going, or the minimum capitalization going, is not $5 million really. I mean, the kind of people or the kind of foreign investment that was coming in wasn't really that much concern about $5 million because most of them invested more than that. It was the timing. It was the challenge was in the language in the Press Note 10, which said that minimum capitalization must be brought in within 6 months of commencement of the project. And commencement of the project was in first time in Press Note 10 defined to mean the sanction plans. So if you did not get your $5 million within 6 months from commencement of the project, that was pretty early stage, you were in effect ineligible to receive foreign investment for the rest of your time without regulatory approval. Now that became a huge challenge, and at a policy level and obviously informally we did check with the FIPB, and those approvals were pretty forthcoming. They said it will be forthcoming, though we didn't apply for it, but conceptually people felt that this was an unnecessary shackle in achieving, in receiving foreign investment, because 6 months from sanction plans was a very short time, and many times foreign investors wanted to make late stage kind of investments. Commencement of project was a new definition, by the way, that the press note 10 added. Press note 2 of 2005, the original press note talked about a concept of commencement of business. And commencement of business was, in many ways and many written documents, understood by the DIPP, and they've told us written form that commencement of business really meant the date on which the first tranche of foreign investment came in, or when you entered into the foreign investment agreement. So the parameter was that 6 months from the time when foreign investment came in, you could keep on receiving foreign investment until the time you were in construction development, right? That parameter was then changed to commencement of project in press note 10, which linked it back to sanctioned plans. Now the challenge is, we don't know, we haven't seen the final print, this is still in press release form, we don't know in which form will the final draft come out. Because if the final draft does not incorporate the terms of commencement of project or until what time you can bring in, we might retrogress to the situation of press note 2, where you then could say that you can bring in foreign investment till any stage until it is construction development, which then brings you to a question on when is a project, or until when can you say a project is in construction development. The view that many people then took was it was until you receive the occupation certificate. That was as grey as you could get. So now let's see how this is worded, but there has to be some parameter that you should say that could determine whether the project is still in construction development or not. And if it does not define any parameter, then technically, and I'll draw the reference from the REIT regulations, which define a project to be completed only once you receive an occupation certificate. So that's one bit on the minimum capitalization. I think the third important change is from the perspective of the So the third important change is, I think, from the perspective of opening up of the completed asset portfolio. I think we all know we tried very hard for the REITs to come in, and when we were pushing in for the REIT regime, I don't know Neetu is here or not, but through APRIA we made a lot of recommendations, met with SEBI and those discussions, but ultimately when the REIT regime came up, because of tax challenges and because certain commercial challenges, the REIT regime never took off. For those of you who are interested in this book, Yellow Book, you have a section B which has several articles on REITs and the challenges why it didn't take off. But one of the challenges was, apart from REIT regime, was that why did we bring in the REIT regime, was that we wanted to allow for monetization of stabilized yield generating assets. And in the FDI regime, there are two challenges that restricted or precluded foreign investment into completed assets. The first challenge came in from what we call as the capital account transaction regulation, which is the mother regulation for all for all kind of foreign investment, whether it's foreign direct investment, foreign portfolio investment, foreign venture capital, and RI. Those capital account transactions prohibited any kind of foreign investment in any form in what we call as real estate business. And real estate business did not mean anything; it just excluded construction development and bridges and things like that. So we did not allow real estate business, it was a prohibited category. And the other was obviously from an FDI policy perspective. The mindset always was that, the money should come into construction development, money should not come towards what we call a speculative capital, but towards developmental capital. So if you're getting in a foreign investor, let's develop something, create some value. And there I think the concept was always this, that if you are investing into a commercial real estate asset like a shopping mall or any other stabilized asset like a business center or an office complex, the concept was that this is not speculative. It is not speculative because you are rendering a service when you're running a mall, you are not just earning lease rental income. You're providing many services. You're giving lift. You're providing security. You're providing all the infrastructure around it. It's just like you're running a hotel, right? So it would be incorrect to say that merely because I'm earning lease rental income, that I become real estate business and my entire nature of my investment gets shrouded as a concept of speculative activity. So I think that was the concept that we got discussing, and the MOF was quite keen at that point in time to allow for investment into commercial real estate asset, and I think that is what is crystallized in this press note. The press note 10 of 2014 did lay some kind of inklings or indications that they will allow into operation and maintenance, that they will allow for investment into companies that were engaged in operation and maintenance of real estate assets, of stabilized yield generating real estate assets. But now this press note makes it very, very clear that earning of lease rental income will not amount to real estate business, and you would be allowed to invest into completed assets in terms of shopping malls, business centers, and township. But while this is a very progressive press note, I think two things must be kept in mind. One is the spirit of the law. The spirit is not that you come and just and that's the way we look at it, and that you just come and it's a pure speculative activity. The concept of opening it up, and I can say that because we were involved in some of these discussions, I think the concept of opening it up is that you're rendering some amount of service. So pure play rental activities, or pure play lease rental activities where you're only involved in lease rental and no operation maintenance, will still be a questionable act. Let's see how the final print turns out, but I think those are some of the critical aspects. Happy to answer on the questions later on.
May I just sort of interject here? So what I wanted to say, and what I want to ask Nishchal and Ruchir both, right, is from a fund manager's perspective, when we go and use the different consultants and advisors and we create a structure and we go and show it to an investor who is an institutional investor overseas and they're used to best-in-class practices, oftentimes that structure is subject to different type of interpretations, 6 or 7 different ways, right? Now, has it become better? It has become, quite better, but it's never black and white still. We still struggle with that. So I guess question to you guys is, what's the journey for it to go further and become black and white? Because we see some government bodies becoming really good with it. So what is there a role for the law firms, a role for the advisors? How do we get to that point where you can put a structure down on a table and it's black, white, we know capital gains, we know service taxes exist in those particular ways, and everything is not sort of open to multiple levels of speculation?
Yeah, no, I think that's a more esoteric but a very practical question. I think in India probably the approach should be that don't just go by what's written in law, because no matter what legal opinions anyone, me or any other law firm gives you, if regulatory action has to come, it will come. So rather than taking legal opinions and reading the law by the letter of it, I think let's understand the spirit. Each one of us and many others, should use our offices and connects with the regulators to understand what's the spirit. And I think implement it in that spirit. Obviously, back it up with legal opinions and everything, but I think the spirit becomes more important. What Modi government is also proposing is a supra-appellate tribunal. So currently RBI and the regulators behave in a very discretionary, arbitrary way, which is no appeal. You never appeal against an RBI decision in the Supreme Court, even though you technically can. But there is a concept paper which should be implemented soon, which will talk about the establishment of a supra-appellate tribunal wherein all appeals of RBI and other bodies can be heard by a quasi-judicial body, so there can be some hearing at the end of it.
I think as advisors, we follow one principle, that anything that we suggest, if tomorrow it is on the first page of Economic Times, will we be able to defend it or not? And that's the principle we follow, and that takes care of both the letter and spirit. But just to add to what Ruchir said, I think there are a couple of other amendments in the press release which came out, and path-breaking amendments, especially for non-resident Indians. Traditionally, if you see, the government has always given a preferential treatment to non-resident Indians, and that's why the NRI regime was specifically carved out from all the foreign investment regimes. But the NRIs over a period of time started getting treatment which was not envisaged earlier. So if you see, all the investments by NRIs are allowed only directly. So only if the NRI directly invests in the Indian company or in the Indian property, the benefit of the NRI regime is available. The problem with this treatment was that most of the NRIs live in countries which do not have a great tax treaty with India. So for example, a US based NRI wants to invest under the NRI route or as an NRI under the FDI route. The problem was that there is no capital gains tax exemption between the US and in the India-US tax treaty. Similarly, the same thing for the NRIs from UK and some of the other developed jurisdictions. So there was no flexibility which was available with the NRI community to pool in their money in an intermediate vehicle, which is what all the funds do, where you pool in money from LPs in one jurisdiction which has good tax treaty network with India, and then you take benefit of the treaty between that jurisdiction and India. So that was not something that was available with the NRI community, and that was a huge problem because it was actually impacting the IRRs for the NRIs when the money used to ultimately reach them, because it used to go through number of layers of taxes in between. Second issue which NRI community was facing and which has still not been resolved is the government still doesn't allow NRI community to invest in listed bonds, which is something which is available for other types of investors. So this is one case where the government has given an unfair treatment to NRIs versus the non-NRIs. What the press release has done is the government has at least addressed the first issue, where NRIs are now allowed to invest through pooling vehicles. So NRIs can pool their money in a jurisdiction which has a good tax treaty network with India, and you can invest in the Indian real estate companies. The second advantage which government gave to Press Note 7 of 2015 is that all the investments which come through the on a non-repatriable basis, which is through the NRO account of the NRIs in India, will be treated as domestic investment. Now this is a huge relief because lot of conditions which apply to NRIs investing on a repatriable basis do not apply to NRIs investing on a non-repatriable basis, because this is considered a domestic investment. So your sectoral caps, your other conditions, pricing restrictions, all these restrictions don't apply when NRIs invest through the NRO from their NRO account. So this is something which has been a big relief, and in a way we have gone back to the, there was a concept of overseas corporate body which was withdrawn by the government on September 16, 2003. But again, after 12 years, we are back to the same regime, and which is a big plus as far as the NRI investments in India is concerned. The second big change which happened, which has been announced in the press release, is that foreign investment in LLPs will be under automatic route instead of a approval route. Now this is something LLP, there are more and more businesses which want to use LLP as a structure as compared to company, because typically in real estate type of businesses where the income is typically upstreamed to the investor rather than you looking at an IPO of the project company. In those type of situations, when you upstream cash, there is a dividend distribution tax which has to be paid in a corporate structure, which is why the LLP structure was coming very handy, because any distribution by an LLP to the partner does not require, there is no dividend distribution tax that needs to be paid. But the problem with the foreign investment policy is, even though foreign investment in an LLP has been brought under automatic route, there is one condition, that if that sector has any performance link condition, then foreign investment in that particular sector for LLP will not be allowed. The problem with real estate sector is the foreign investment has certain performance link conditions, like lock-in is there, which is a performance link condition, which means foreign investment in an LLP which conducts real estate construction development or real estate completed asset type of venture is not allowed as of today. So I think LLP as an option is not there. Hopefully it should open up. I don't see any reason why they have not allowed foreign investment in a real estate LLP, because this is the sector which requires maximum number of LLPs as compared to any other sector. So that's another big change which is there. The couple of other major changes which have come, and this is something which is a big plus in the press release, is on the lock-in restrictions. If you see the way the lock-in has worked right from the first press note in 2005. Earlier there was a lock-in, and government has changed the stance at least 6 to 7 times in the last 10 years. It started with lock-in for 3 years for minimum capitalization of $5 million. Then the government changed its stand to say that it's not only $5 million. The entire investment will be locked in for a period of 3 years from the date of investment. That stand again changed, where the government said the 3 years will not be calculated from the date of initial investment, but from the date of each tranche of investment. So if you have done a last mile funding for a project, then even after the project is over, the cash is sitting in the SPV. You still can't exit because you have to wait for 3 years for the last tranche which came into the project SPV. Then they again changed the law to say, which was through press note 10 of 2014, where they said that forget about 3-year lock-in. The problem is that most of the projects are not getting completed and foreign investors are exiting. So let me withdraw the 3-year lock-in condition. You can now exit only if the entire project is completed or upon completion of trunk infrastructure. Now this came as a huge setback for the foreign investors, because a lot of them were sitting on the investment for more than 3 years. The project was not complete because of various reasons, which we all know in India. Approvals don't come on time, markets are not good at times. So because of all these issues, the project was not completed, and trunk infrastructure also takes its own time. So a lot of these deals got stuck since 2014, and in the last 9 months there have been so many applications which FIPB has received just for exit, because 3 years have lapsed but the project has not completed. The big reprieve which has come under the new press release is now that 3 year has been introduced again, and what the new press release says is that the exit can happen if 3 years have got completed, or even before, if your project has got completed or you have built the trunk infrastructure. So it's best of all the worlds in the last 10 years which the new press release has got, and this is again going to significantly help the exits for the foreign investors. One of the other major change which has been brought is earlier non-resident to non-resident transfer during the lock-in period was not permitted without FIPB approval. And if you all recollect, there was a famous case of D. Shaw and 2i Capital in the DL 2i Capital, which was an FEC, which was one of the first FECIs that was registered. And the problem there was that they wanted to transfer the stake before 3 years, and the stand that was taken is that there is no repatriation of money happening outside India before 3 years, because it's an NR to NR transfer, everything is happening outside India. So there should not be any requirement for lock-in for a period of 3 years. But DIPP clearly together with FIPB gave a view that not only the repatriation outside India, but you cannot exit also before 3 years, and which is where all NR to NR transfers also view was established in the market, that you can't exit before 3 years. The new press release clearly says that even before 3 years or before project completion or before completion of trunk infrastructure, you can transfer your stake to another non-resident. Now again, this is again a big positive as far as the foreign investment in real estate is concerned, because a lot of times the project needs money, but the same foreign investor is not able to give much because of various reasons, like the investment period for the fund may have got over, or the foreign investor may not be interested to further invest. In those situations, if there is another foreign investor who is willing to take a call on the project and invest further, the foreign investment can be transferred without FIPB. The investment can be transferred without FIPB approval to another non-resident investor. Another issue which used to come up earlier was if there is an NR to NR transfer, then would the 3-year lock-in again restart for the new NR? So let's say the NR had invested in 2013 and it transferred to another NR in 2015 after the 3-year lock-in got over. Would this 3-year restart for the new NR, new non-resident? I think there again, although we'll have to see the fine print, but at least the press release is quite clear that within the lock-in period, NR to NR transfer is allowed, which indirectly also suggests that the lock-in, which was earlier applicable more at investor level, now is applicable to the investment. So the new NR will only be subject to the residual lock-in rather than a fresh lock-in. So I think broadly these are the major changes which we have seen, coupled with what Ruchir said on the press release, and
Sure. No, I think we'll take questions. Heard Karan on the experience on the investment platforms. We have heard Ruchir on some of the routes, how things have changed over a period of 10 years. And after 10 years, since 2005 and now 2015, some of the path-breaking, policy changes that have come in. So, what's your thoughts, Nishchal, if I may continue with you, in terms of some of these routes and the platforms which are set up and the structures which are there, considering the new policies, how do you see some of the new structures coming up in terms of the real estate sector?
So I think interestingly the way, we have seen the sector from 2005 to 2015, and the way the fundraising has happened in the sector. If you see pre-2008 days, most of the funds were raised through the fund structure, where the LPs gave free hand to the GPs and LPs followed a hands-off approach. And the result was also not that great because significant returns were not given to the LPs by the GPs. And we saw post 2008, because of the global financial crisis, the fundraising was almost dormant for the next 3 to 4 years. But in 2012, we saw the emergence of platform structures with Godrej APG being the first real estate platform in India. And we saw the pension funds and sovereign wealth funds being more inclined towards the platform model rather than a fund model. Because what they wanted was more involvement in the decision making for investment and divestment, more accountability of the GPs, and work more like partners rather than GP taking all decisions and LPs just receiving information reports from the GP on what's happening on the project. So that's where we saw the shift to the platform structures with first being Godrej APG, then we also saw Adya Kotak platform, we also saw Canadian Pension Fund Piramal platform, and Heinz Adya was another platform. So we saw the emergence of platform, and if you see currently a lot of fundraising which is happening is based on the platform structure more than the fund structure. And hopefully, as Karan mentioned that with the GP also establishing the track record, we might see again the emergence of fund structure as compared to the platform structure, just like we are seeing the resurgence of equity structures compared to debt structures in the last 1 year. So that's something which is an interesting change which we are seeing. As far as the domestic fundraising is concerned, we saw a change in 2012 when the alternative investment fund regime was introduced, where category 2 AIFs were permitted to raise debt or rather what we call debt AIFs for real estate. And there we saw many domestic fund managers raising funds through that route. But at the same time, one of the biggest issue with debt AIF was that the debt AIF cannot leverage except for temporary requirement. So from a tax perspective, even though the AIF are given pass-through treatment, but ultimately the investors still end up paying taxes on the capital gains and interest which is received from the real estate project. But at the same time, what we also saw was with the AIF, we also saw mushrooming of NBFCs in India. And we saw some of the big players globally following into the NBFC business, like GICs, KKR, Vikram Pandit, JM Financial. All the large NBFCs have been set up in the last couple of years, and there's a huge there are a lot of deals which are happening through the NBFC platform as compared to the AIF platform. And coupled with NBFC, what we also saw post 2008 was the listed bond structure, where number of offshore debt funds were raised because, as I mentioned, it became very difficult for the LPs to get their money back on the equity funds, given the fact that the Indian laws also became very complicated to take out money in an equity structure. There was a buyback tax which was introduced a couple of years back, where 20% income distribution tax has to be paid on the buyback. There were issues on the put option with assured IRR. So all the deals which were structured where foreign investor had a put option on Indian developer all came under the scanner of the Reserve Bank of India. So equity deals became very complicated, because of which post 2008 we saw a number of debt funds coming up. And with debt, the best product to invest through a debt was the listed bond product. And there have been number of deals which have happened in the last 7 to 8 years through the listed bond product, and because it gives best of both worlds, you can pretty much get the same equity type of returns on the bond, and at the same time it gives you the same security as a lender. because of that the product became very popular, and till date also we have been seeing majority of the funds using the listed bond as a product. So broadly, this is what we have been seeing as far as the fund model and the fund structures are concerned. And from a jurisdiction perspective, I think not much has changed as far as offshore pooling is concerned. For equity structures, Mauritius and Singapore are used a lot. For debt structures, we have seen Singapore and Netherlands also being used a lot because of the preferential treatment which you get on interest coupon because of the India, Singapore and India, Netherlands tax treaty.
Okay, so maybe giving a little possible rest to NISHCHAL and going back to RUCHIR and coming to his favorite structure, particularly the NCD structures. What are your thoughts in terms of some of the issues people face in that structure? Is there a particular issue like the 3-year lock-ins or any other points that one needs to consider? And with the new FDI regime and the other structures available, will this structure still remain most interesting structure, or you will see a change in terms of people preferring some different structure?
Yeah, no, I think I obviously feel very strongly about NCDs. We have in many of the sessions, I think I've tried to allay the misapprehensions that people have about listed non-convertible debentures. I think all of you will know about this, but these are essentially bonds that an Indian company can issue, and any registered foreign investor, which is registered as a foreign portfolio investor, and that registration is very simple these days. Almost any non-resident can register as a foreign portfolio investor, can subscribe to these bonds, and these bonds can have whatever commercial characteristic that you want them to have. They can have security interest because these are pure debt bonds and they're rupee denominated. You can have whatever security interest that you want through a local security trustee. Whatever payout on the bond can be structured in the form of a coupon and a redemption premium, with the redemption premium being linked to a commercial formula. It can be several deals have happened. Actually, even equity deals happen on the listed bond platform, because bond is just a mechanism of how you invest. But if the inherent nature is, let's say, payable when able, so that means that you have to pay nothing on the bond, neither the coupon nor the redemption premium, unless the company has cash flows. Then it really is functioning like equity. It's a structured form of equity giving you debt-like tax deductions. So obviously it is extremely popular, and many times people ask that, is this legit? Are you trying to do something very cute by saying that, oh, you know what, it's a bond, but it's really functioning like equity, and will someone come and catch us? And the answer always is that how I borrow and how someone lends is really a function of commercial discussions between the parties. They can be lending and borrowing at whatever commercial terminologies. Someone might say that I will lend you at 12%, but you must pay me irrespective of having cash flows. And someone might say, I will charge you 18%, but you pay me later, or pay me as and when cash flows come. So that's really a commercial function of how you want to structure your bond. And I think in 2008, when this regime came up for the first time, the idea of the government was that we had a buoyant equity market, but we did not have a debt market. Globally, about 25 to 30% or even up to 40% of the debt needs of a company are met. The conference is now being recorded. So up to 40% of the debt needs of a company are typically met by way of corporate bonds. And in India, the only way people thought of raising funding or debt funding was just to go to bank, which is not correct. So the government thought that let's introduce this simplified form of debt listing or simplified form of debt, where an Indian company could even borrow through listed bonds, and we will have an equally buoyant debt market, just like we have a buoyant equity market, if you call it buoyant at all. So that was the framework within which the debt market was opened up in 2008, and over the years it became increasingly popular even for equity, structured equity, or whatever kind of structures that were there. But I think nothing can go very smoothly in this country. So then they came up with the concept of commitment to capital, and they wanted to kill the entire CP paper, or the commercial paper market or short-term trading of bonds. And they said, there must be some kind of commitment. So there should be a 3-year lock-in in terms of bonds. And in early this February, just when the bonds were the most favorite way of doing deals, they came up with a circular saying that every bond must have a 3-year residual maturity, which was investor specific. That means if an FPI or a foreign portfolio investor had to acquire any of those bonds, they must have a 3-year residual maturity, right? So therefore, if you're transferring that bond to another non-resident, he can also not acquire those bonds, even though they are listed, unless the residual maturity when the other non-resident or the foreign portfolio investor acquires is also 3 years. Now, 3 years wasn't just sufficient. So and this circular was issued by the RBI and then subsequently, first issued by SEBI, then subsequently by the RBI on the same date. But then they came up with certain FAQs or clarifications, because 3-year residual maturity, people were confused that can you pay something, can you redeem some part of the principal or not? And the view that came out across from the market was no, you cannot redeem any part of the bond, because residual maturity was then understood in the most conservative manner to mean no part of principal can be redeemed. Otherwise, some people were cute enough to say let's redeem 99% in the first 2 years and just remain 1% for later. So then they said, the question came up that can you have amortization possible in these bonds? And the RBI clarified. The RBI said yes, amortization is possible, and provided you maintain the average maturity of 3 years. But in the way the question was worded was that the question talked about average maturity, but the answer to the same FAQ, and you will see that in our hotline, the answer talked about yes, amortization is possible provided the duration of the bond is 3 years. Now people were confused, because from a bond terminology perspective, maturity and duration are two very different concepts. Duration can be computed by way of your Macaulay, advanced Macaulay formulas and all of that, and average maturity was really a concept, where you use the ECB type average maturity concept. So people got confused how to do. And while the market has been doing a majority of the deals based on ECB based average maturity, the challenge is that with amortized bonds, the way the language reads of duration, there is also some section which has gone to the RBI, and RBI has given some kind of a position that you must use the Macaulay formula for computing the duration of the bond. So there are two sects which are prevailing right now. Now the question, I think, Karan, it's one of your kind of questions. What does a person do when there are different views in the market? Do I not redeem anything of the bond at all? Do I use ECB based weighted average maturity principle, or do I use a Macaulay formula which really kills my deal, right? Or advanced Macaulay, which is even more complicated. So I think where you end up is that go back to the RBI, and RBI has just recently again clarified to us in a separate matter that this is only ECB maturity concept, and the word duration is really used in a more generic sense, but they did not intend it to be duration as per the Macaulay formula. So that's one view. Go to your custodian bank, go to your authorized dealer, take his view, back it up with legal opinions, and just do the deal. That's how, and most of the deals in the market have happened on the basis of ECB or the average maturity principle. If you can work out a Macaulay, nothing like it, but there are deals happening on the other formula also of ECB weighted average methodology, where you take the term duration in a more generic sense. Because when the law, when the clarification is itself not clear, how do you interpret? Then that's the way to interpret. You go to the RBI, go to the custodian, take appropriate legal opinions, back yourself and do the deal, and cite the precedents.
So, Nishchal, do you have a different interpretation?
So I can't issue? Because we work together. But I think generally, as Ruchir mentioned, the two circulars have complicated life a lot. And just like I think the FDI policy changes came after the Bihar elections, we hope that the West Bengal elections will also clarify a lot of things for the FPI circular. So I think in addition to what Ruchir said, I think there are a couple of other issues which are there in the FPI bond circular, and I think one major issue is the circular FAQ specifically mentioned that no put or call options are permitted within the 3-year maturity period. the question is, does the put or call option work only vis-a-vis the borrower, or even the promoter of the borrower cannot enter into a put or call option agreement with the foreign investor? I think there, ideally, because it's a bond and not equity, typically it should be between the borrower and the lender. But because there is no clarity on this, the view that we have been taking is that it's better to not enter into any type of option arrangement, even with the promoter. And then the question comes as to, can you, if not an option arrangement, can you enter into a binding arrangement with the promoter, because transfer of bonds to resident is allowed within the 3-year period. The problem there is that because this is a listed bond, the Securities Contract Regulation Act applies to it, and because of that, any type of forward contract that you enter into with respect to a bond where you are fixing the price and fixing the date for purchase of the bond, it could get covered under forward contract, which are not permitted under the SCRA. So that's really the challenge we are facing. And one of the structure which typically comes up is, in case there is money which is lying in the company, the foreign investor finds a domestic NBFC which will buy the bond, because transfer to domestic resident without any contract is permitted. And then the domestic NBFC can, once the bond is purchased by the domestic NBFCs, the borrower will redeem the bond to the domestic NBFC. So it's more of a bridge funding which takes care of the redemption issue before 3 years. But again, you need to structure it properly. Sometimes the discussion comes up on, if not NBFC, can the promoter himself do it? Because the promoter company can purchase the bond, and or the borrower can give a loan to the promoter company, and then promoter company can use the same money to purchase the bond without any contract. But there again, the challenge is it might defeat the spirit of the regulations. So one of the thing that to better the structure, one of the things which can be looked at is, first the promoter borrows from a third party, buys it, and then redemption happens from the borrower to the promoter. That's a more kosher structure as compared to a structure where the promoter is being funded by the borrower, because what you are doing indirectly is something which is not allowed directly. So that's these are the two things which we have seen are again creating a lot of issues for FPI's investment in the listed bond.
I think just to add, these are actually very interesting times, and we are pushing on this on the policy side for clarity on this bond lock-in issue, and hopefully it should be sorted. And we are also getting written responses that it will actually be computed as per the ECB weighted average maturity concept. But these are interesting times, as said, also in light of the entire opening up of the commercial asset space. So REITs haven't been successful in India, and one of the reasons has been that the entire taxation regime, there are many taxation issues. Obviously, there are many commercial issues. I don't want to repeat all that. There's not a REIT session. But one of the challenges is that from a domestic investor perspective, it wasn't working well from a tax standpoint. But with the bonds coming in and with the commercial space opening up, all the LRD and the CMBS market can now fully and freely open up, and you can actually have offshore pooling structures which will use the listed bonds and all of it. And therefore, I think this 3-year lock-in is going to be very, very critical to understand for these kind of structures to work. But in many senses, I do see a resurgence of Singapore-based pooling vehicles, the SBTs, the London listed vehicles, using that to monetize on Indian commercial assets.
Maybe Matsuo-san and maybe Karan as well. I think legal and regulatory aspects, obviously, Ruchir and NISHCHAL have elaborated a lot. But what are the other things on top of your mind when you look at an investment or partnering with any developer in India? Are certain check the boxes always there in your mind as okay, unless it is 1, 2 and 3, I'm not going to look at any investment? And maybe Karan, you can
I'll let Matsuo take that.
Okay.
Since he wants to partner with us.
Yeah, that's true.
Firstly, for this country, I'm new, but I was so impressed about all the structures and also rules. In this kind of developing countries, it's very rare. My experience is not so broad, but experience in other country in Asia, China or Vietnam or those market, there's no structure like this, and I was so impressed. You guys are so smart. You guys just can think of so many rules, and it's good in a way that we can structure the risk and return in a debt and equity, in a debt provide some, this NCD provide us some good way to redeem the capital, which doesn't happen in other countries. So that's very a good part. But the other thing is that Richard's point, that this new deregulation give us a chance to look into this income producing property.
Yeah.
I mean, for foreign investors' point of view, it's easy to buying into this income producing property. But I was thinking until last week, I can't do this. So I'm right now, I am trying to participate in a project with a joint venture with the developer for residential project. My thought process is trying this small project and having a good market exit, and trying to move into this income producing property. But now this new opportunity come up, so I'd like to look into this long term. I mean, originally I told you, in the Japanese has such a small cost of capital and a long-term view, it's natural to go into this income producing property like office and long-term holding. But these new change give us more chance, and also having us coming in, I think more capital, not only Japan, from the rest of the world, the capital coming in, the cost of capital for real estate is going to go down, which is going to give you a good upside potential for the growth. I think it's a good cycle it will start. But coming back to your question about how I look into this joint venture partner, I think the most important thing is, since this cultural and also legal difference is so big, I think I like to have some good transparency from the developing partner, and also understanding how different I am from you guys. If the developer understands some kind of maybe Western or American or Japanese developed countries way of doing business, that makes us so easy to going in. And actually in this country there are so many developers who has done dealt with the foreign capital so far. That's also very surprising, and I'm very happy to deal with these guys. And also as I said, if they give us more transparency, I know there's some murky area in the market in this country. I mean, this is not only your country. The real estate is in real estate. Same in US, Japan. We have to deal with this. But as long as they give us all the transparency to us, we understand this, so we can swallow some of the issues. But how much we can swallow, if I understand, I can gauge it. I can talk into my investor, so I can deal with this. So transparency is probably the most important part.
Any thoughts, Karan? On
So my only thought on it is, earlier I commented that we think that there will be a resurgence of the fund structure, maybe not exactly blind pool right away, but I think it will evolve into that through some more innovation. But it's not maybe just the Indian managers. So if MATSUO and then are going to come in, then the foreign managers will by default bring in the fund structure. So I don't think fund structure is dead. I think it's going to come back with the foreign managers and then Indian managers, and I think that is efficient.
So no discussion on innovative structures can end without tax being discussed. So what are your thoughts in terms of the tax structuring issues, more particularly to NCDs or any other tax issues that you see in this routes?
Yeah.
And are they still on the top of the mind when the structuring happens, or they have somewhere matured, particularly with the structures? Maybe RUCHIR and NISHCHAL, maybe 5 minutes on that.
Sure.
Yeah, no, sure. I think one of the questions, at least, I mean, obviously, larger amount of deals in the real estate space, especially whether it's income producing or self-liquidating, do require an element of debt from a tax optimization perspective. Deductions is what everyone needs. And that's probably one of the reasons why NCDs became so popular. I think the question that many times comes across is that what is the nature of this redemption premium that we get on the bonds? And I think so let's analyze that from a couple of perspectives, from the borrower perspective and the lender perspective or the investor perspective. From a borrower perspective, at least, the concept is quite clear that whatever you pay, whether by way of coupon or by redemption premium, any payout on a bond is actually in the nature of a revenue expense and a deductible for the borrower company, and there is absolutely no debate on that. That has been settled in many cases, in Madras Investment Supreme Court case and many other cases. That debate has been set out. The challenge that many times comes across is that from an investor perspective, what is the treatment in their hands? And many investors are very keen to regard this as a capital gains treatment to kind of achieve a 0% tax benefit, especially if they're coming from jurisdictions like Mauritius or Singapore, where there is no capital gains tax under the Singapore-India-Mauritius Treaty. And even though, by the way, there has been, from a tax perspective, these bonds, because they can only be purchased by a foreign portfolio investor, these are listed bonds, the withholding tax or the ultimate tax rate on these bonds is 20% at the hands of the recipient. That 20% tax gets reduced to 15% in case of Singapore. It gets reduced to 10% in case of Netherlands. And there is no tax treaty with respect to interest beneficial treatment with Mauritius, although we are expecting that there should be some change in that. So you can come in from whichever jurisdiction, but obviously there is some amount of tax leakage no matter where you come from. If you could actually qualify this as a form of capital gains, you could save on the entire tax leakage. Now, there is obviously one school of thought that one is that, from conceptually, there is no law that requires reconciliation of the books of the borrower and the lender. Both books are independent. Both people can record the assets and incomes differently. So from a lender perspective, even though the borrower recordal is very, very clear as a revenue expense, from a investor or from a lender perspective, the treatment, can that be of interest income or capital gains? Now let's analyze how can it ever be capital gains. From a treaty perspective, redemption premium, whatever you give, is actually in many of the treaties, the way they define interest includes redemption premium. But from a Indian Income Tax Act perspective, redemption premium or redemption of a bond, because the asset, once they hold the bond, is actually a capital asset. And that's the law also now. After the 2014 amendment, there's a requirement that any investment held by a foreign portfolio investor will be held as a capital asset. So when you transfer a capital asset, should typically be earning capital gains. Now transfer definition includes transfer, whether you are transferring on the floor or extinguishment of a capital asset. Redemption is nothing else but extinguishment of a capital asset. So from the perspective of characterizing the nature, it's your call whether you can take it as interest, because that definition is also wide, or capital gains. The way we can look at it, and many people have looked at it in the past, and there are many examples of this, is that it is really from a Domestic Income Tax Act perspective, capital gains, because you're extinguishing a capital asset. Now, and you can obviously choose, the SSE is at benefit to choose whichever provision works better for him. And again, from the perspective of the treaty and the Income Tax Act, you're again free to choose whichever is more beneficial. So for the characterization of the income, you take it as capital gains, and then you go to the treaty to only examine what is the rate or how will the capital gains be taxed. Where, if it's India-Singapore or India-Mauritius Treaty, you could characterize it as capital gains, and you could, take, the capital gains exemption subject to the LOB provisions in Singapore or wherever it's applicable. I think the market practice is really, the more conservative view is really to take it as interest, but this is one of the thoughts which, you people can explore. It is technically viable, but obviously, when you don't pay any tax to the government of India, they don't like it. So you might expect some questions, but that's the way it can work. Second part is, many people say, because there is a restricted, if your coupon is up to 14%, or the way they call it SBI base rate plus 500 bips, you're subjected to a much lower withholding tax. The 20% base tax rate gets reduced to 5%. Many people ask that, should I be subjected? So I'll keep my coupon to 10%, and I'll keep my redemption premium as, as over and above that, right? Is is that possible or not? Now again, it goes back to the, and then will I still be subject to the 5% benefit, or will I be required to pay a higher, or will I not be entitled to, because my overall bond payout is more than 15%? Or the way the provisions read is that they only talk about interest income in the hands of the recipient. So if the interest income, not interest expense, so if the interest income at the hands of the recipient is up to 14%, the withholding should only be 5%. So now it's up to you how you're categorizing. If you're categorizing your redemption premium as capital gains, then obviously your interest income is only up to 14%, then it should be 5%. If in your books you're reflecting your redemption premium as a form of interest income, then obviously you are breaching the 14%, and your withholding should be the maximum of 20%, unless it's reduced to 15% or 10% case of Singapore or Netherlands. So that's again one of the, from a tax perspective, how these kind of bonds can work.
Just one
any
last
additional
point.
thoughts?
I think all this structuring is good till 1st April 2017, because from 1st April 2017 the general anti-avoidance rules are going to come in, and hence what would be most important is a lot of funds which are being raised right now, how the fund documents are drafted, how the board minutes are drafted, all these things will become very important, because one of the things which the tax authorities are going to look at is if any investment has been made post 1st April 2017, they will apply the general anti-avoidance provisions, and if they see that the debt instrument has the character of equity, then there are high chances that the interest will be considered as dividend, which will be subject to dividend distribution tax. So I think it's very important how we look at these things, how the documents are drafted, how you structure the debenture terms, what rights you are giving to the investor. So you have to balance between the commercial requirement of the rights versus the tax exposure that those rights can create for the investor to get a preferential treatment.
But also
So-
any structures which you do now will be grandfathered.
Yeah.
So any investments which you make, not
Any
the
investment,
structures.
yeah.
So, but
So it's
investments
applicable
which you
only
make.
for investments made post 1st April 2017. But I think before we end, maybe Vyapak, you can swap the roles. I
sure.
can be moderator for one question. I think recently there have been significant changes which have been announced as far as the dispute resolution mechanism is concerned. And what we saw from 2010-11 to 2013, there were a number of disputes which happened between the real estate funds and the developers. Is there anything good, or is there any reprieve for the foreign investors in the new proposals?
Yeah, so it's always good to have the last word, right? And as dispute lawyers or litigators, I think you usually have the last word or the last laugh, as we say. But yeah, I think recently government has really responded to the much needed changes and amendments, the way the dispute resolution happens in India. They have come up with 2 ordinances. One in terms of again very very substantial changes in the Arbitration Act. And if I may just take a couple of minutes because I think we might want to open the floor for questions and answers. But I think there were 2 or 3 major problems in terms of foreign investors' disputes with the Indians, particularly on the real estate side. I think one was the delay itself, that it took endless time when the dispute started till the dispute even reached a particular stage. It took considerable time. I think the amendments talk about making sure that the delay aspect is addressed at every level of arbitration. And the way the amendments have come about, it is even beyond some of the global standards. As NV said, you go to any institution, they will say it will at least take 18 months to 24 months, while this law says initially the period should be 12 months. So I think obviously it's an aggressive view to what has happened in the past, and we'll see how it turns out. But the message is very clear that if we have to bring about ease of doing business in India, I think dispute resolution is going to be one important criteria. So I think at every stage delays have been addressed in arbitration, and it is now time bound of 12 months with maximum of 6 months of extension. unless court approves any further extension. Otherwise, even arbitrator is penalized for his fees. So they have taken care of those situations when it comes to delay. The other big problem was with the kind of jurisprudence came about right from 2002 to 2012. There was always a question as to if it is a foreign seated arbitration, whether I can go to Indian courts, or whether it is only in Indian courts I can go to interim reliefs and things like that. I think the law again clarifies the situation, because original judgments allowed even foreign seated arbitrations to go to Indian courts in certain situations, while the later judgments completely barred that position. So then people were again perplexed in the sense that, okay, if I sit my arbitration outside, but if I need to go to Indian courts, what do I do? So the new amendments take care of those situations where you can even go to Indian courts if there has been a carve out in your arbitration clause with regard to foreign seated arbitrations. The third most important concept which is coming up for the first time in India is the cost follow event. Now this is very prevalent in all the developed jurisdictions, which was not there in India. So now it is explicit in the law that whoever is successful should get all the costs that they have incurred in the process from the other side to get through that process. Now this was never there, and this is going to be one of the major deterrents for counterclaims or claims which were not real claims in that sense, but were made just to delay the process. Because at the end of the day, if you have to really pay the costs of the other side, even defending such frivolous claims, then you will have to even pay for not only your lawyers and the fees of arbitrator, but even the other side. So I think some of these changes are going to really change the way it happens, but ultimately I think it is the culture and the mindset, right? So we'll obviously see how things work out in the future, but definitely the law and the regulations have given a clear direction in this regard. So I think there are 2 or 3 aspects if I touch upon, particularly on the real estate side, right? One is your security enforcement issues. One would say, okay, I have to go to courts, but what about my adjudication? I can still do it through arbitration. Earlier that route was also not very exciting, because that in itself was taking 5, 6, 7 years. Now at least that process, either in India or outside, you will be able to do at much faster pace and in a time bound manner, so that your security enforcement stage comes much earlier by the time your adjudication things are over. Second is your multi-party, multi-agreement situations, where every time it was an issue as to who are all involved in this dispute, whether it is the promoter entity or only the SPV. We have 2 different agreements, 2 different lending arrangements. I think now with the law changing even for domestic arbitrations, some of these issues can be dealt much more efficiently, and you will be able to club a lot of disputes into one to get things clarified. And the last but not the least is the whole new regime of commercial courts. Now we have seen this in many situations. In debt recovery we saw tribunals, in IP intellectual property we saw separate tribunals, securities we have SEBI and SET, but commercial courts like Singapore or like London, I think at least the concept has been introduced and made a law where specific commercial courts are being set up for commercial disputes, which will cover any and every dispute that we are talking about here. And again, there the way the timelines are fixed, it talks about 16 to 18 months to complete the whole process, include a case management timelines. So the whole civil procedure code, which was coming in the way in terms of enforcement and the procedures in the court, has been done away for commercial courts. A new case management process has been brought in terms of written submissions and written arguments, time-bound filings, even taking away rights. So the whole natural justice defense has been taken care of by putting some of the strict timelines. So I think a combination of arbitration regime and commercial courts will throw upon a lot of different avenues as to how you put your dispute resolution clause ultimately in the agreements, and possibly we might be seeing some innovations there as well, because even commercial courts can throw upon a lot of different options, and not just arbitrations, which are today a norm in this kind of
So in a
disputes.
sense, when we used to say that if there's a dispute, investors are a very vulnerable community. So you have two sets. First is liability crystallization, proving that there is a default also or not, and second is enforcement of that award. Together, this can take even about 8-10 years, sometimes 12 years, and all that. Now that reduces to
At least the regulations
Within the
and
life
laws
of the fund.
support it, and we'll see how it obviously spans out. So coupled with a lot of other changes, the government has also taken care of some of these issues, and we'll see how it spans out.